Hey everyone, and welcome back to the Your Money Your Life podcast, episode 212 of the podcast. Make sure wherever you're listening, you like, subscribe, 5-star rate, and review the pod. Before we even get into it, if you're watching on YouTube, make sure you hit the link to hit the notification bell, as well as leave comments and be subscribed. A lot to get into today, so we'll get right into it. First and foremost, let's look at what the market is up to right now in general and over the past week. So the big thing is Nvidia earnings that came out, and actually the last podcast we talked about the surge in the stock most recently, the last year or so. And they just released earnings that were really eye popping. Shares are up 13-14% pre-market. Their total revenue rose 265% from a year ago. 265% from a year ago. And this is all AI. This AI, artificial intelligence boom, is incredibly profitable to their business. If you look at their earnings, their revenue, 5 years, 10 years back, all these things to now, the jump they've had over the last, 1 year, the last quarter, this AI boom is incredible for this company. It's now the fifth largest company in the US by market cap. And it's just a crazy boom that Nvidia is having, and it's this AI enthusiasm that's really buoying not only Nvidia but other tech, the Magnificent Seven as they're calling them now, which is the Amazons, the Googles, the Facebooks, the Metas, the Nvidias, and Microsoft. So Tesla as well sits in there as well. So it's buoying the rest of the stock market. It's buoying uh, um, the rest of tech. But yeah, this AI boom from Nvidia again. They released their earnings yesterday. It's a closely watched stock, of course, and they had a really strong quarter. And again, based off of what they see in the AI business, even if they said China is slowing down, they did mention China might slow down, but it's still a strong earnings for them as the shareholders and investors really liked it. Look at the past 5 days, barring today, because we're pre-market when we're recording this, we're about flat, but the market is signaling, futures are signaling a strong day today. We'll see if that holds throughout the trading day. But the futures, the pre-market look is showing a strong day in the market today. We'll see again if that holds throughout the day. But we've been flat the past week. We've had a couple of days where the market pulled back a little bit, and a couple of days where the market was up. Again, we're at all-time highs roughly. So, I mean, it's really strong times over the past year for the market. So for investors, it's still the inflation front. It's still how these earnings are doing for these bigger companies, especially like Nvidia's, the Magnificent Seven. Those are the ones that people are going to be watching really, really closely and keeping an eye on. So that's pretty much your market update. Now, if we roll into current news, there was a lot. We're just talking about inflation just now. And so we've still had the Fed's meeting minutes that came out from their most recent meeting. And they said that inflation is moving down sustainably, but they want to see it moving down sustainably before they consider to cut interest rates. So a lot of people are wondering when the Fed will cut interest rates. You could surmise spring, fall, all those different things. That's roughly been my guess. But they did say in their most recent meeting that they don't want to move too quickly to lower borrowing costs because that could have a negative effect on the economy if they move too quickly to lower borrowing costs, and we still have inflation that's hurting the general public and consumers. That would just be the wrong move to make because you can't really just keep playing with the market and lowering and increasing. They have to make a move and make a move one way when they do so. So the question still remains: when will the Fed lower rates? Because we are at the highest levels we've been at in 22 years. And they want to, again, wait for price increases to slow closer to their target of 2%, which we're right now at 2.9%. So those Fed meeting minutes said there's still displaying caution, and they want to be cautious of making that move and not making it too early to really. They've tempered the market. They've let us know that they don't want to do it too early. So that's still the plan. But we'll keep watching month after month what actually occurs as we get new data down the line. BuzzFeed is actually cutting. They plan to cut folks as well as they sold Complex. So if you don't remember, BuzzFeed used to own Complex. They sold it for $108 million and it's planning to cut its own workforce by 60%. BuzzFeed, I believe, if they were they public company, if they still are, I don't even know. But yes, they did hit the public markets 2021. Of course, when everyone was investing in everything. And there was easy times back then. But now, 2022, 2023, only sustainable companies are surviving. They're having a lot of trouble. So they paid 300 million for Complex 3 years ago when everything was selling at the highest multiple possible, and they lost roughly $200 million, wrote down $200 million on the deal as they sold it. But yeah, BuzzFeed's in trouble. The advertising dollars are hard to come by. Eyeballs are still hard to come by. And now, without the free flow of capital like you saw 2, 3 years ago, they have to make cuts and right size their business to survive and to spit out a profit. I don't even know what the chart on BuzzFeed looks like, but let's look. Let's take a look. Does anyone know what their ticker symbol is? Probably Buzz, I would assume. Oh, BZVD. As you can see, this is not a company I was highly intrigued by. Yeah, look at over the past 6 months, down 50%. Past year, down 88%. It's trading at 21 cents on the dollar right now. Um, yeah, this is a company that people would have told you is a buy 2, 3 years ago. Um, and now it's really in struggling terms. 5 years, they're all time it's down 97%. So yeah, just this company's gonna have to be delisted soon. I'm surprised that it's still even listed. It's got to be below the requirements very soon. But my fiance loves the articles. I read them every once in a while. I used to see them on my Facebook timeline. Um, so another social media company that's actually doing an IPO is Reddit. This is one, I'm not a huge user of Reddit, so they're doing their financials and they're going to go public. At least they're going public in times that are more normalized, right? So we'll actually see what the demand is from investors. And so they reached a deal with Google worth about 60 billion a year to let the search giant train its artificial intelligence models on its content. So Reddit plans again to go public. They're going to give Redditors a chance to buy stock first in the upcoming IPO. Um, this privilege is usually reserved for big institutional investors. So remember, in the IPO process, the banks take the IPO book to big institutional investors, get a feed and read on demand. They sell the stock to those investors, and the stocks then go stocks bought by the banks. They sell to investors. It goes to the public market, the secondary market, where everyone else, the general public, is able to buy it. So we'll see. I mean, again, this is another one when I'm not highly, in tuned with, nor do I think is, a really big must have. We'll dig into their financials and see more. But they first filed in 2021. I think it was smart that they didn't go in 2021 because, again, inflated numbers in 2021 when everyone and everything could go to the market and you would get a bid. And so I actually like the fact that they waited to more normalized times to attempt this IPO. So we'll keep an eye on it. We've talked about it before, and we'll keep an eye on it. Let's get more into tech news. Google is getting some heat for its AI image generation. So the generation function of its Gemini, the AI model, is saying it's produced racially and historically inaccurate images of people. So Google admitted the model was missing the mark in this instance and promised to allow image generation of people again once it's fixed. So they pretty much stopped the function and they're going to allow it again when they fix this function. I saw a lot of heat on social media. Haven't used the AI generation, but check it out yourself if you let me know what you think if you've used it. City CEO probably getting some flack as they released the bank CEO earnings. City CEO was one in the top 5 or 6. Her pay was 26 million last year, and she's leading the restructuring of the bank that will slash about 20,000 jobs. I guess the saying is, hey, if she took a little bit of a pay cut, she could save those jobs. Her pay includes a $1.5 million salary and 24.5 million in stock-based and cash incentive awards for 2023. Despite the 6% pay boost, however, Frazier remains the lowest paid of all U.S. major banks chiefs and the only woman as well. So David Solomon, Goldman Sachs, 31 million, and James Gorman from Morgan Stanley, 37 million. Citigroup net income did drop 38% last year thanks to rising expenses and slowing revenue. So she's got to work ahead despite just cutting jobs. She's got to raise revenue in several divisions and try to see if she can, save her job. They're paying her a lot to do so. We'll see what happens. So that was the biggest news. We did talk about NVIDIA earnings. Another big M&A transaction, I think this is huge. Capital One is buying Discover in the biggest proposed merger of 2024. So Capital One, I'm sure you know Discover as well. Capital One recently announced a 35.3 billion acquisition of Discover Financial. It's a bid to protect itself against the rising tide of fintech and regulatory threats. The deal has to go be approved. Of course, it's huge merger and acquisition has to be approved. Um, this would make Capital One leapfrog JP Morgan as the biggest credit card company by loans and would solidify its position as the third largest by purchase volume. So that's a huge all stock deal, which, is again a big deal. I think it's a big chess move from Capital One. And yeah, it's really just you don't see a lot of M&A this big, especially in this time. And so I think they're trying to make a strategic play to be bigger, to encapsulate their network and insulate that much more. So we'll see. A lot of fintech and different players popped up in 2021. Some have far gone away, but some are still there. But this deal gives the company a stronger hand to battle other fintechs and big tech companies. The more they can separate themselves from the pack, the more they can future proof themselves. So it's going to be a really see one if the regulators allow this, and two what the combined company looks like afterwards. Owning a network allows us to deal more directly with merchants rather than a network intermediary, Fairbanks told analysts. We create more value for merchants and small businesses and consumers and capture the additional economics from vertical integration. Yeah, will regulators approve? That's going to be a big one. Proposed legislation from Senator Dick Durbin aims to cap the fees charged by Visa, Mastercard, potentially blowing the economics of credit card rewards programs. So this is going to be one to watch and see how it goes through. Other big news in our roundtable, I want to discuss a couple items. One, just the truth about the market. I still see fabrications, untruths, things that people don't know being touted in the market about stock market, especially for people that's rightfully so or not, haven't had the education, haven't had the time, don't have an expert they're working with. So we're going to break down a few images and show the truth about the stock market and kind of break down those fallacies. So one, people always say, what happens if the stock market goes to zero or my money goes to zero or all these things? Again, it shouldn't if you are working with an expert, right? If you're buying BuzzFeed stock with all your money, then yeah, you quite possibly could lose a lot of it. Um, but again, if you're working with an expert and understands portfolio management strategy, if you look at this world index, this really much takes the all country world stock market, the whole world in an index, and it goes back to 1987, and it shows you different times, right? Black Monday, that was in the late 80s. People have told you that was the end of the world. We recovered not only like a year and a half later, it looks like tech bubble. Tech bubble wasn't even that bad. It was just a period of non-growth in the market. Covered 3 years later. Really good times until excuse me, we had that was the late '90s, early '90s for the Kuwait invasion, some geopolitical issues. The tech bubble comes later. And this one actually was decent pullback because we had such a high rise. Right, the higher the rise, the more the pullback will be. And again, people have told you the tech bubble was the worst time in the world, recovered in the mid 2000s. This one did take a little bit longer, but there's still a recovery back to all time highs. The Great Recession, the bank credit bubble, people have told you the world is over, 38% in one day or 30% over the depth of the pullback. Recovered for a whole over a decade. Recovered for over a decade. This little blip, and it doesn't even go. We cut it off here. This chart cuts it off. So let's even take it to our own charts and just look at the US economy. Then we get to the pandemic blip. People have again told you the world was over. We recovered quite nicely, right? And back to higher highs. And then, of course, the 2022 pullback, which we recovered from again. So I highlight this to say that people really don't fully understand that investing for longer is better. Still, they try to one they'll just say, okay, FOMO kicks in at the highs and they want to buy at the highs, and then think that it's going to keep going up just right when they buy, and then they give up when it goes down because they don't have the right intentions when they're investing. You're not going to time things. You're not going to be able to time the market. Otherwise, you wouldn't be timing the market. Meaning, if you knew how to do that correctly, which no one does, you would have enough funds where you wouldn't be doing that. So again, another example there. And let's go to this one where it's again understanding that investing doesn't equal gambling. If you're investing over a period of 1 month, the odds of making money are 62%. The odds of losing money are 38%. This chart showing you the longer you invest, the odds of you making your money are higher. So over a 1 year period, it's 75% odds of making money, 25% odds of not. Again, it's 1 year period. 5 years, there's nearly 90% chance that you will make money. 11% chance you won't. Over 10 years, 95% chance. Over 15 years, 99.8% chance. So again, if you want to flip a coin and try to invest for a day, again, that's your prerogative, but there's no guarantee of that. And you should have a different mindset, especially if you're smart or trying to do things in the way that I think is right. Now let's talk about like losses and gains, unrealized, right? Because again, these are unrealized if someone doesn't sell and they get a recovery. When you lose funds, when you have an unrealized loss, you have to gain more than the loss to recover fully, right? And it's the more depth of the loss, the more the gain has to be. So if you had an unrealized loss of 10%, the recovery has to be 11% to get you back to even. If you have an unrealized loss of 20%, the recovery mathematically again has to be 25% to get you back to even. If it's unrealized loss of 30%, the recovery again has to be 43% to get you back to even. So mathematically, that's what people understand is when you have a loss, the recovery has to be higher to get you back to even, right? So that's one thing to note. And again, this is just showing the time frames again, outdated, but still remains daily. If you're just investing for daily, the chance it's positive about 54%. So that's the 1 day you have pretty much a coin flip. Quarter, 3 months, um, 68%, 1 year, 74%, 5 years, 86, 10 years, 94. And again, this is looking at historical data, right? So they look at data for 80, 70, 90 years, and they use that as the linchpin for the data. So that's, again, an eye-opening statistic that people should be able, hopefully, to understand, look at, and get a better barometer for. The other thing in this roundtable I want to talk about is when people should actually pull from their IRAs. There's different opportunities, different times. Um, usually see it as the last line of resort for money, liquidity, and cash, right? So you've exhausted your emergency fund, you've exhausted any other savings, the checking and savings account is gone, then you want to pull from the IRAs. So if you've been laid off, you have a lack of emergency fund, no other backup plan, and then now you really need to pay rent, buy groceries and other necessities that you have to do, then that's when you should possibly look at it, right? And again, there's penalties result. There's potential penalties for withdrawing from a 401k or IRA. There's potential taxes that you must pay, but it's okay to withdraw when we're going through some of those issues, right? Um, so again, those financial issues might be, and of course, we know that through the CARE Act, there's been some more leniency with the government allowing people to withdraw, and also return some of the money. There's loans against 401ks, not really loans against IRAs. Um, but there's situations where, and the reasons why you want to avoid it is because the money withdrawal won't grow, so it's not being invested. And when you pull out from the stock market, especially when things are down, as we just showed in that chart earlier, one, you're removing the liquidity, you're locking in the losses, right? Because if you sell and have to take money out, you're locking in those unrealized losses versus allowing potential recovery to happen. And if you do allow recovery to happen, it has to be higher than the losses, right? Um, so you could also be missing out on realized investment gains when the market picks up. There could be fees associated with 401k loans if you do a loan versus a withdrawal. And so there's a bunch of different factors. It's not the best situation to do these things, honestly. but I understand that it does happen every once in a while, as well for people. So those are some good tips in our roundtable. Again, make sure you are tapped in, hopefully saving, hopefully budgeting, hopefully doing those things that we talk about on the daily, and things should turn out all right. Make sure you share with us your family and friends as always, and we'll talk to you next week.